These numbers remind us that the challenge is not a lack of willingness to learn, but rather how effectively we can leverage technology, better data, and more innovative credit assessment models to responsibly extend finance to millions of viable businesses that remain underserved. But I will also hastily to say, and sometimes it's good to use real examples, good people. When we were working on Hustler Fund, and remember all the private sector players when we were working on the Hustler Fund, it was for free. Using our human capital, what I would call ideal system capabilities, and the collective of telcos and banks to be able to deliver that solution. There was actually a trial that I don't think many people talk about. The people that Philip scored 0 in the model, GOK said, we will backstop. Let's try and give them something. Because with the intention of trying to, I didn't want to use a difficult term because it might not come out well. Rehabilitate. I was going to use, to rehabilitate. So the fellows that was scored 0, there is a number that was placed. The full committee, they never paid. Even if the government gives you, so you should feel some shame and try and repair and rebuild your credit score. They didn't pay. And that is exactly why we have that 9 billion that we're trying to look to recover. But those that took that money, they are fellows who are AAA, better than the individuals we have in the banking system in repayment. But then when you want to lend them a little bit more, GOK says it is our data. It's our customer. So there's a reasoning for all of us to engage, right? Even in Nyota, it will be the same story if we don't set it up correctly. This ring fencing and walling, and then we cry a little bit. As a chairman of Kenya Bankers, I can speak a little bit harsh. Then when I put on the KCB hat, I become kidogo moderate. Those are two different, I'm wearing two different, here it's chairman of Kenya Bankers. So just a reminder. I think, when you're talking about 15% of your total loans, and Governor, we've done a lot. We've come from a high of 19 industries, or thereabout. 23 for some of us, I am the first to confess. To that 15, we need to get to the level of 11, get to single digit, be ambitious. Yet we must grow lending to private sector. It is not it's not just bringing NPLs down. So we must chew gum and climb stairs at the same time. And it's controversial. Your boards are chasing lower NPLs, but the nation, we are all chasing increase in lending to private sector. And that's the difficulty of CEOs. It's not a balanced scorecard, one-page review. That's why we have to work together. How do we get lending to private sector to double digit, particularly for Kenya, and try and bring NPL below 9%? I know many of you are waiting for me to say 10. No, below 9%. And we are the ones who are here today. We have to try and do it. We have to get to do it. Because if you don't lend to private sector, and you're just going to react to infrastructure, bond, and treasury, what Dr. Njoroge used to call lazy banking, we will be crucified, good people. Right? And I know banks today, we are, now CEOs will kill me here. We have the highest return on investments, isn't it? Sindio? But we have to think about sustainable economies. So, Moses, how do we do both? Bernard, you're looking at me, but it's just the truth. We have to do both.
So let me, at the outset, thank the Kenya Bankers Association for inviting me to the 23rd East African Banking School conference. And this conference has, over the years, become an important platform for sharing of knowledge, experiences, and lessons given the increasingly dynamic banking sector. The theme of this conference, Navigating Credit Risk in the Digital Transformation Era, is timely and relevant. We convene at a conjuncture of enhanced complexity and uncertainty in the global, regional, as well as domestic arenas. This is against a backdrop of various headwinds, including the wars in Ukraine and the Middle East, geopolitical tensions, as well as an uncertainty in trade policies. Nonetheless, amidst these headwinds are transformation opportunities arising from advances in innovation and technology, particularly artificial intelligence. To set the stage, the global economy continues to face unprecedented and heightened uncertainty. The intensified geopolitical tensions, especially the conflict in the Middle East and Russia, Ukraine, have disrupted global supply chains, increased energy prices, and elevated trade policy uncertainty. This continues to weigh on global economic growth prospects. The latest July 2026 International Monetary Fund World Economic Outlook update projects global growth to moderate to 3% in 2026 from 3.5% in 2025. And this again was a projection downward. The previous projection that was done in April had growth at 3.1% for global growth for this year. And it was 3.3% before the Middle East crisis. The global inflation is expected to increase to 4.7% in 2026 from 4.1% for the same period during 2025. In the sub-Saharan Africa region, growth is expected to remain broadly stable at 4.3% in 2026 from 4.5% in 2025, and to again increase back to 4.5% in 2027. And despite these global headwinds, as Molenja said earlier, the East African economies are expected to remain among the stronger performing economies on the continent, supported by resilient domestic demand, ongoing structural reforms, and continued investment. Nevertheless, the region remains vulnerable to external shocks, as predominantly net oil importing economies. East African countries are particularly exposed to higher global energy prices, which increase import cost and worsen the terms of trade and place pressure on inflation and widens the external balances or imbalances. Turning to Kenya, the economy has remained resilient in the face of the significant global shocks and uncertainty, and growth is expected to remain above the global and sub-Saharan Africa averages, both in 2026 and also in 2027. And this reflects the resilience and diversified nature of the Kenyan economy, supported by the prevailing macroeconomic stability. The Kenyan economy recorded a strong performance in the first quarter of 2026, with real GDP growing at 5.3% compared to 4.9% during the first quarter of 2025. And this performance reflected broad-based growth across all sectors of the economy, with stronger activity in industry and services. The industry sector grew by 5.4% compared to 4% in the first quarter of 2025, supported by improved growth in manufacturing and construction. Maybe just to pause here on the issue of manufacturing, because manufacturing for a long time, manufacturing has been growing by between 2 and 3% on a year-to-year basis. And certainly in our projection this year, given the increased energy prices and just increased cost of production, we had expected manufacturing to even continue to slow down and to lose its share of GDP. But the first quarter was very promising. Manufacturing grew by 4.4%. It's a very, very long time since manufacturing grew by that much. So it's a good sign, and we hope that will continue.